Apple isn't trying to become a bank in the traditional way. There won't be Apple branches. There won't be an Apple checking account that looks like your local bank. But Apple is quietly moving into something more powerful than banking. The rails, the layer where money moves. And once you control the rails, you don't need to be a bank. You become the system that banks plug into. When people hear Apple Finance, they think it's just Apple Pay, a convenient tap-to-pay feature, but Apple Pay isn't a feature, it's a position. Because payments aren't primarily about technology, they're about trust, distribution, and fees. If Apple becomes the default way people pay, Apple becomes a toll booth on commerce. Small tolls, repeated billions of times. Banking is a habit business. People don't switch banks often, they don't change cards often, and they don't reconsider how they pay every week. So whoever becomes the default wins. Apple already sits in the most valuable place possible, in your pocket, on your wrist, and on your face. The goal isn't to convince you to try Apple Finance. The goal is for Apple Finance to be what you do without thinking. Think about the Apple Wallet. It started with boarding passes and tickets, then loyalty cards, then payment cards, then identity documents in some places. That progression matters, because once the wallet becomes a container for identity, payments become frictionless. And when payments are frictionless, people spend more. Friction is the enemy of commerce. Apple is reducing friction across the entire purchase journey. The real long-term play isn't payment, it's identity, because identity reduces friction more than any discount ever could. If your phone becomes your ID, your boarding pass, your tickets, your keys, and your payment method, then the phone becomes a permission device. It decides what you can access, and when access is smooth, people stop shopping for alternatives. They stop thinking about switching. That's what platforms want, not a transaction. A default environment. Traditional banks compete on rates, fees, and trust. Platforms compete on interfaces, ecosystems, and default placement. Banks have to attract you. Apple is already where you are. That difference is enormous. If Apple becomes the interface for payments, credit, and savings, banks become invisible infrastructure, still necessary but less powerful, like utilities. Here's why this matters financially. Banking revenue is recurring. Payments generate fees. Credit generates interest. Savings products generate spread. Financial products generate retention. And retention is what Apple values most. Apple doesn't just want to sell you a phone. Apple wants to keep you inside the ecosystem for 10 years. Finance is one of the strongest lock-in mechanisms ever created. Because once your money habits are integrated, leaving becomes painful. Most people imagine finance as products, cards, loans, savings. But the highest power is the rails. The rails are the system that moves money, authorization, verification, settlement, and routing. If you control the interface to those rails, you can take a small fee on an enormous amount of activity. And because it's small, users don't feel it. But at scale, small fees become huge revenue. That's why platforms don't need to replace banks. They just need to sit between banks and customers. When a normal bank offers a credit card, it's a financial product. When a platform offers a credit card, it's an ecosystem product. The purpose isn't just interest revenue, it's behavior shaping. Rewards change spending. Spending creates data. Data improves targeting. Targeting increases revenue across services. So credit becomes a lever, not just a loan. Banks know what you spend. Platforms know why. They see your device behavior, your subscriptions, your location patterns, your purchase intent. So when a platform handles payments, it isn't just processing a transaction. It's observing behavior. And behavior data improves recommendations, pricing, offers, and retention. This creates a loop: more payments, more data, better targeting, more spending, more payments. That loop is more valuable than interest revenue. Because interest revenue is linear, behavior loops compound. Savings products are powerful because they change perception. A company that holds your savings feels more permanent, more reliable, more infrastructure than brand. If you trust a platform with your money, you trust it with everything else. Trust expands. And in finance, trust is the moat. Here's the pattern. First, Apple becomes the payment interface. Then, the identity container. Then, the credit layer. Then, the savings layer. At that point, Apple is no longer offering finance. It is hosting finance. Banks still exist, but Apple becomes the front door. And whoever owns the front door controls the relationship. There's a reason this expansion accelerates in the 2020s, because the economy moved from ownership to access, subscriptions, digital services, app ecosystems, and finance is the ultimate subscription, recurring behavior, recurring revenue, recurring data. Platforms want predictable cash flows. Because predictable cash flows support valuation, Apple doesn't need to take big risks. It needs to own small slices of massive flows. For consumers, it feels like convenience. Everything becomes one tap, one wallet, one interface. But convenience always comes with dependence. When one platform becomes the default financial layer, it becomes harder to live outside it. Not because you're forced, because everything else becomes inconvenient by comparison. That's how systems win, not through coercion, through smoothness. The trade isn't money, it's dependency. When your phone becomes your wallet, your ID, your keys, your tickets, and your payment method, then leaving isn't a financial decision. It's a lifestyle disruption. And platforms don't have to force you to stay. They just make leaving inconvenient. That's how modern power works. Not through restriction, through smoothness. Traditional banks make money by taking risk. They underwrite loans. They manage defaults. They comply with heavy regulation. They hold capital against losses. Platforms don't want that burden. They want the upside without the risk. That's why the platform move is so powerful. Apple can partner with banks for the balance sheet, while Apple controls the interface, the distribution, and the customer relationship. So the bank becomes the utility in the background, and Apple becomes the brand in the foreground. And the foreground is where loyalty lives. Once the customer relationship moves, the economics follow. Apple isn't trying to become your bank. It's trying to become the layer your bank runs through. And that's more powerful, because banks compete with other banks, but platforms become environments. And environments don't compete on rates. They compete on whether you can imagine leaving.